Good morning. Good morning, everyone, and thank you for being here. Thank you, Don, David, and Mark. Today we will have John speaking about cotton markets update. We will have Mark Welch. He will be talking about grain, and David Anderson. He will be talking about livestock markets. If you have any questions after they finish his presentation, please feel we welcome every question that you will have. So ask as many questions as you want, and if not, at the end of the presentation, you will also have the chance to ask anything that you still would like to know. So John, you are the first one. You're ready to go whenever you want.
All right, so I'm going to focus on the new crop cotton outlook, the 23 crop that's coming up. We've been trading, for the last 6 weeks, 2 months, 6 weeks, in a pretty narrow band in the low to mid 80s, really around the mid 80 cents per pound range. 83, 84, 85. We try to make some little stabs out of that range and keep getting stuck in it. You could call it an equilibrium. I think the market is trying to balance an uncertain supply picture with an uncertain demand picture. Either one of those variables, supply could be a pretty super tight, or it could be a healthy crop, more than we need for the weak demand that we've been seeing, but then demand may improve too. So supply and demand are both highly variable. So let's just take a stab at them in detail. Looking at the supply picture, what drives our notion of production this year is always starts with acres. So everybody's expecting fewer acres this year compared to last for various reasons. It's expensive. We may not have the drought wipeout that we had last year. So there's sort of there's two ways. The economist way of thinking about how many acres are going to get planted is by thinking about the relative prices of other crops. And so this chart does that formally with the price of corn, which this is new crop corn. ZCZ23 is December 23 CBOT corn futures, and they've been trading a little under $6 a bushel for a while. And this is December cotton, new crop cotton, which, like I say, has been trading 83, 84, 85 cents a pound. If you express the relationship of those two as a ratio, that's what's across the bottom of this chart. And that ratio has been ranging between 7, 7.5, up to 8, which historically, here it is way out on that scale. Historically, if you have the price of corn that much better than the price of cotton, first of all, that usually means that soybeans is better than cotton, and peanuts may be better than cotton, and wheat may be better than cotton, because the whole grain complex has had stronger prices, and Dr. Welch will talk about that. But stronger relative to cotton means that we don't plant as much cotton, and historically you can see that in years where the corn price was a whole lot better, like 2009, 2008, more recently 2015. We can cut down to 9 million acres, a low level. And that's this dashed line is where this chart, this economist's approach to predicting acreage would tell us. Now, the trouble is, just to keep us guessing, the trouble is we've had some grower surveys, regularly scheduled grower surveys of what they intend to plant, and the early season surveys would predict something a whole lot higher. The first one being from Cotton Grower Magazine. They call a bunch of people in the winter, and they publish a number at Beltwide in early January, and they published 11.5 million was their prediction, 11.5 million planted. And then the National Cotton Council does a survey, a little more rigorous than cotton growers, and they do that from mid-December to mid-January, and they publish it at their annual meeting, which was yesterday morning, and they came out with 11.4. So if these surveys are accurate, what they're reflecting is grower influences on growers that go beyond relative prices. And, you know, those influences could be fixed costs. If growers own harvesting equipment, you know, you own a $900,000 harvester, you're probably going to grow some cotton. Or if you rent land from a landlord who owns a gin, you're probably going to grow some cotton. Or the kind of the psychological influence, if you're in Georgia or West Tennessee or Arkansas and you had 3 bales to the acre last year and had a really good year and did well with cotton despite the high input costs, well, maybe you're going to at least keep cotton in your rotation. So those are all the reasons that we might have a somewhat higher number. Now, what's it actually going to be? I don't know. We've got some more milestones that'll come along and confirm or contradict these guesstimates. The first one being March 31st from USDA, and the second one being March the 30th. June the 30th. So we'll have to wait for those, and the market will be kind of waiting and anticipating and buzzing and guessing. But let me just point out, there's a big difference in the outcome of production, whether we plant this much or this much. 2 million acres difference can matter a lot. We can have extremely tight supplies if we only plant this much and then it's dry, which it is. Or if we plant more acres, then we got a little bit of cushion there. And if we have good weather on top of the higher end of acreage, then, you know, we could have more cotton than we need. So we're setting ourselves up for a lot of uncertainty. The number that came out yesterday is, you know, pegged, you know, there's one bit of evidence, but we need confirming evidence. So we'll have to see. But anyhow, acreage is one question. What the conditions are dry. The forecast of the La Nina condition, the forecast of the Pacific water temperatures is that they're going to be in a neutral state by mid-spring. That doesn't necessarily mean that the soil moisture here will be, you know, any less dry. That remains to be seen. So we could have a very dry planting season, and like I say, that's going to matter. That'll be a lot more impactful if it's on a lower planted acreage, but that remains to be seen. So I guess the way I'll sum this up is we could be super, super, super tight, and we could have high prices in one extreme, or we could really have ample production, ample supplies, and moderate to slow demand, and that would give us another extreme of lower prices. Or we could be somewhere in the middle, and I kind of show that with these 3 seasonal charts. This is the high price scenario where we have, if we planted low acreage in dry conditions and we had super low production and demand was increasing, well, man, that would give us a really tight outcome of ending stocks. That would give us a seasonal pattern that would basically be strengthening. And if you move this seasonal pattern onto an 85-cent futures base, that suggests that we could have prices going into the 90s, going towards $1, if everything lines up to give us smaller carryover, which again would be low acreage planted, high abandonment, and recovering demand. If those all get together for the extreme, we could have prices marching up to $1 following this average seasonal path. But the flip side of that is if we plant, let's say, 11.5 million, and then it begins to rain, we get timely rains, we get, you know, average production or average abandonment of 15%, you know, we'll have a fairly strong crop. And if that lines up with a continuation of kind of weak demand, or if we slip into a double dip recession, which would mean weak demand, well, that means we have more cotton than we need. And that would put us historically on the path of this blue line here, where, you know, the cotton market tends to weaken as we get data through the spring, through the growing season, and it weakens the most at harvest time. We could have prices pushing back down into the lower 80s. We could have prices in the 70s if that was to happen. And then this red line is just sort of the middle case of, you know, basically things not being quite as extreme either way, kind of a flat to slightly lower. You know, this could give us futures up to 90 maybe, and then sliding back through the 80s from 90 to 80. So a lot of different outcomes. as always, remains to be seen, and we'll get new information coming through the year. Again, here's the next planting reports that are going to be closely watched to see if they confirm or contradict that number right there. So a lot riding on that. I'll get off, but I'll be available for questions now or at the end.
Great. Thank you, John. Thank
You're
you.
welcome.
Any questions for John? You can write them in the chat if you want to. John, do you want to stop sharing so Mark can?
Oh, sorry.
Yeah.
Thought I did that. There we go.
Well, the next speaker, Mark Welch. Mark, whenever you want to start sharing and start your.
All right, Pancho.
Presentation.
Let's see. Let me get everything signed up here. All right, good to be with you this morning. Appreciate the opportunity to talk about a few changes in our grain market over the last few weeks, and also maybe some factors that are influencing some profit margins as we make plans for this 23 crop. Again, just kind of looking at the path of how we got to these relatively high prices in grain that we've seen, over the last year now. If you kind of draw the line of when Russia invaded Ukraine, kind of either side of that line, we're still at relatively high prices, even though we've lost a lot of that premium. And those prices came as a result of relatively small crops in the U.S. the last couple of years, some struggling production issues in South America, and then a strong import demand of feed grains from China kind of set us on this path higher for the last couple of years. And if you look at this spring now compared to basically a year ago now, when we saw the invasion of Ukraine, we're still looking at prices about in that same range, or even still a little bit better. If you look at the corn market in particular, grain, sorghum, and wheat. Again, those are Texas cash prices, so still relatively high prices, even though we've lost some of that premium associated with Russia's invasion of Ukraine. What we've seen the last couple of months from USDA, however, is significant trimming of our use estimates. They were cut all the use categories for U.S. corn in the January WASDE. And here then last week with the February numbers, no changes on the supply side, but again, continuing to make cuts on the estimated use of corn as we go through this marketing year. And that's a particular challenge in the the economic environment that we're in right now. Dr. Robinson talked about that with the cotton market, and it matters a lot in the grains as well. We do have relatively tight stocks because of the situation we were just talking about over the last couple of years. And if you look at the stocks to use ratio, or the metric I like to use is the days of use on hand at the end of the marketing year. And those are particularly tight over the last several years. Now, if you look at the globally, those numbers perhaps don't look quite as concerning. But if you consider the fact that China is holding 70% of the world stocks of corn, they import about 10% of world imports, but they only export about 1%. And so they're not likely to trade and influence markets, even though with their large level of stocks in terms of marketable grain that's going to be affecting prices. So look at those calculations if you take China out of the equation and then look at the U.S. alone. Those numbers in 20, 21, and 22, those are relatively tight levels. You've got to go back to 2010, 2011, 2012, the high prices we saw in that environment to find something similar. And so the question, of course, is, are we now in a situation as we go to 2023, either because of an increase in supply, what's going to happen on the use side of the ledger? Will we start to see those days of use on hand remain in this tight level, or will we start to expand those to some more comfortable levels of a stocks to use ratio moving ahead? The economic headwinds impacting consumption of grains are likely to be with, and other commodities, are likely to be with us for a good while yet. If you look at the battle of inflation and the efforts of central banks to get the cost under control, they're going to do that by raising interest rates. And you can see the black line there indicates the U.S. Federal Reserve, as they've increased the federal funds rate over the last year or so now, going from virtually zero, now pushing that up toward 5% as we're here in early 2023. And we are perhaps seeing some impact on prices. The red line is the CPI, the Consumer Price Index, another measure that takes out food and energy, a little more of a core index measure from the personal consumption expenditures index that the Fed kind of watches. Yeah, those have come down a little bit the last couple of months. But again, if we're going to get back down to 2% inflation, we've got a ways to go. These interest rates are going to be with us at these levels for a good period of time. And so that will have an impact on economic growth and prospects for the economy well into 2023 for sure, and perhaps beyond. And of course, Henry kind of put that in perspective. I appreciated this comment. Yeah, the challenge is if we raise rates too much, we cause a sharper downturn in the economy than was needed to weaken those price pressures. We don't raise them enough, and high inflation becomes more entrenched, and it takes even longer and higher rates to get inflation under control. So it certainly is a balancing act from the Fed and central banks around the world. And that just gives an indication of grain use can go down. When the economy slows down in times of very high prices, there's a strong correlation between grain consumption, which is that red line, and growth in income in the economies that we could classify as emerging or developing economies around the world. And a strong correlation between those two factors. But if we continue to see economic headwinds or challenges to economic growth in the world economy, that is not going to be supportive of increased grain consumption. And particularly if we see challenges of increasing consumption in a year that we have a rebound in supply, that's my recipe for lower prices in 2023. The prices that we saw last year are near record high prices at $6.70 a bushel. That's the U.S. season average farm price. The all-time record high was back in 2012 at $6.89. So again, these are prices that will provide incentives for production, and those are global incentives as well. One major market to watch is the crop in Brazil that's being planted right now. They plant that corn crop right behind their soybeans, and this is their exportable production. This is primarily where our competition will come on the world global stage, will come from Brazil and this region outlined with these green lines. And you can see it, their calendar kind of matches what we have here along the coast in Texas and even the southern parts of central Texas. They're planting that crop in February, early March. They'll harvest June, July, and early August. And so that certainly will be a market influence of the degree to which that is a competition for U.S. exports. And take that green area where they primarily produce that corn and then kind of match that up on the drought index that was released last week. Of course, yellow and red on that map would be drier conditions. You can see still very dry down in Argentina. But generally speaking, moisture conditions are very favorable at this point as they're harvesting their soybeans and getting that corn crop in the ground. So it looks like a big corn crop coming out of Brazil here for 2023. And one thing of significance in the WASDE report that came out last week is that for the first time since 2012, and only the second time in history, Brazil is projected to be the largest corn exporter. You can see that those exports are up from last year from 48 million metric tons up to 50. And then the U.S. export projections significantly lower this year than they were a year ago. So Brazil projected in this marketing year to take that mantle as the #1 corn exporter in the world. China's feed grain imports, yeah, they tripled in 2020 from their 20 million metric tons. They went over 60, and now they've started to dial those back to some degree. One thing that concerns me there, not only in terms of just general feed grain imports, and U.S. share of those, but particularly look at the sorghum component of that. The current marketing year estimate is that China will import about 5 million metric tons. That's below the average over these last 10 years or so. The average has been about 6, and that's significantly lower than the sorghum imports of the last 2 years, the strong sorghum imports we saw in 2014-15. And what we see in those years when China is importing a lot of grain sorghum is we tend to see sorghum in the United States trading at a premium to corn in our cash markets. And so seeing that that the decreases in import volumes of grain sorghum, of course, sorghum prices will be basically, they'll follow along what happens with corn, but it's going to be difficult for sorghum to hold its price presence and the strong value it has relative to corn in years that we're seeing relatively lower import, particularly from China, which of course leads the world in sorghum imports. Looking a little about input prices as we go into 2023, look at that natural gas price falling off sharply as we end January. Now, grain sorghum, our fertilizer prices are highly influenced by what happens in the corn market, what happens in natural gas, and certainly volatile markets when we're looking at that natural gas component. But that is causing a little bit of a downturn in our fertilizer prices as we're early in the spring here and getting ready to put a corn crop in the ground. Now, I looked at cost of fertilizer per ton. I put these are March prices from USDA, and I've got the price of urea per ton and the price of anhydrous ammonia. And just in absolute value, yeah, we're looking at prices that are record high prices for urea and for anhydrous ammonia. But if you put those in terms of what you produce with that fertilizer, in terms of relative to the price of corn. And so this ratio that I've shown here in this chart is the price of nitrogen per pound, whether it's urea or anhydrous ammonia, and divide that by the dollar bushel value of corn. And now these prices are still really high in 2022 and 2023, but particularly when it comes to the urea market, we have seen several years over the last 25 or so that urea has been priced higher relative to the price of corn. And then even in 2023, that urea in the current market, and again, these are the January and early February prices, that urea has actually, in a price per pound relative to the price of corn, is actually cheaper than anhydrous. And that perhaps creates a little bit of, protects that profit margin as we're going here to 2020. Still high prices, but perhaps a little more moderate than we saw a year ago. And if you look at where the corn break-even prices are, these are using kind of a Central Texas kind of budget. A current break-even could be that 530, 550 range. Of course, every operation is going to be different. There's still some profit margin there if you're looking at average yields and looking at these input prices that we're looking at now with a little bit lower fuel prices compared to a year ago. Fertilizer prices down a little bit than they were a year ago. There's still some possibilities for profit. So certainly a place we need to look at creating some protection in our profit margin outlook. The prices are still such that there's still some profit opportunity out there given normal yields. And the concern, of course, is we push that days of use on hand to the right. We're down in that 31, 32 day carryover, and that's giving us these high prices up 650 corn. And that would kind of support that fundamentally. If we happen to see a year in which we see an increase in supply and a more moderate increase on the demand side of the ledger, I think we could see that days of use on hand for 2023 push down closer to that 40 number. And if we were to do that, even at this higher elevated level of cost of production, maybe we don't go back to that long historical relationship, pushing that down, say to $5.50, $5 corn. That really starts to tighten that profit potential as we get into harvest. So I think that's kind of my outlook going into 2023. Certainly high prices, high cost, tight margins. I think we're seeing corn acres are going to be up this year, given that more favorable relationship with fertilizer. If we have a trend yield this year, that's going to be significantly higher than 2022, raising that stocks to use ratio, putting moderate downward pressure on prices. Of course, the global economy and global trade matter a lot. And so those factors will matter. And of course, with weather as well. So kind of my outlook for today. Appreciate the time being with you. And I too will be sticking around for any questions or comments as we go through the rest of the meeting. Thank you.
Thank you, Mark. Thank you a lot. Any questions for Mark? David, are you still there?
I'm here.
Okay, anytime you want to put your slides.
We'll see. Oh, hell. You know, every time I turn this on, it wants to update. You know, some kind of crazy thing.
You can step in here and use my computer if you want.
Well.
Oh, you're at
uh-oh.
home. So.
Yeah. Hold on, I got a problem here. Let's see here.
Oh,
see my
you're
screen at all?
sharing everything.
Okay, I couldn't tell. How's that, Pancho?
Perfect. Yeah, looks
Thank
great.
God. You know, the crazy thing always wants to update something every time I turn it. I got to speak. So anyway, I avoided that. That'd probably a 4-hour process. It's good to be with you guys. Thanks, Pancho, for organizing this again as well. I sort of jumped ahead. Let me jump right in. I'm going to spend the bulk of the time talking about cattle today. I think that's what I'm going to spend all the time on, but a little bit on the inventory report that came out January 31st. I got a kind of a set of charts here, some points I think worth making on all of them. You know, I think various analysts like to look at it different ways. This is a chart of total cattle inventory, all cattle in the U.S., dairy cattle, beef cattle, cows, feedlots, the works, back to 1963 on this. And you know, I think the main thing, it certainly highlights a large number of changes that have happened in the industry really over the last 50 years or so. But if we look over here on the far right, really our latest report, we're down to 89.3 million head. The report was largely what was expected, almost down 3% in terms of total cattle. That's about what we expected, particularly with the large numbers of cows going to market. So I don't think that was a real surprise, but I think it's instructive to have kind of this long-term chart on here. You can certainly see this cycle that we're in now. We're not down as low as we were following the drought yet in terms of total cattle numbers, but we're moving that direction pretty rapidly. I thought this was a pretty interesting chart to kind of put it in some total perspective. Now, I didn't do this chart of beef production, and you might know that we set a record all-time beef production in 2022 of 28.3 billion pounds of beef production. So while our number of animals is going down, our beef production continues generally to rise. Although that's going to change this year with falling, our cattle numbers have fallen dramatically enough, our beef production will begin to drop as well. The same basic idea on this chart in terms of cow inventory. The red line is beef cows in the U.S. We were down almost 4% and a touch over 4% if you consider that USDA did some revisions to the year before's inventory number. And revisions happen from time to time. They were really, you know, kind of truing up their numbers with past surveys. I certainly expected some revisions, and the revisions were sort of in the direction I basically expected. But again, 28.9 million beef cows. We're not down as far as we were following the drought of a decade ago. But I think the evidence would suggest we're headed that direction still. You know, John used the drought monitor. Certainly that's going to dictate where we go in terms of cow numbers this year. I was glad to hear Mark talk about cheaper feed for us. When I show some calf prices in a little bit, I think that certainly, if that materializes, that's certainly going to help us in terms of calf prices and give us a boost to those prices as well. The dotted line down there is dairy cows, 9.4 million head, little more than we had a year ago. You know, I think overall, I do expect over the course of this year, dairy cow numbers to decline a little bit, and we'll likely get at or below where we were at times in 2022, really driven by some struggles on milk prices that should limit any kind of growth in terms of cow numbers. But certainly beef cow numbers are declining, and it's pretty easy to see that cycle there as well. To show it a little bit differently, I think I kind of like to use maps every once in a while. This one has number of beef cows by state. You'll see Texas at 4.3 million. That was down 125,000 from the year before. You know, I was a bit I was a bit surprised by that in the report. I sort of expected fewer beef cows, particularly given the number of beef cows that went to market. If we look at our regional beef cow slaughter, which is how USDA reports the data, our region includes New Mexico, Texas, Oklahoma, Arkansas, and Louisiana. But if you put all those together, beef cow numbers were down over 300,000, and that made a little more sense given the slaughter numbers. But I think it's worth looking at. Where's the bulk of the cows? It's the Great Plains. It's Texas and North. You throw in Montana, that's where the bulk of cow-calf production is. And if you look at some states in the Southeast, Florida, Kentucky, Tennessee, Arkansas, we may not often think of them as being very large states, but in the South, we certainly have a lot of beef cows, and certainly, some pretty big states in the West too, with a number of them over 600,000, certainly over 500,000 beef cows. So I think that gives a good picture of where cows are. But if we want to look at the changes, where were the big declines year over year? It's in the plains where most of the cows are. And if you look at John's drought monitor map, it certainly lines up pretty well with that, where the sharp declines in number of beef cows was where the drought has been the worst. And so some declines in the Southeast as well. So certainly, drought has driven a large portion of these changes, along with high costs as well. So, I think using these maps gives us a kind of a good look at where the cows are, where the big declines are, and sort of can shape our view for the coming year. I thought I'd also use this feeder cattle supplies outside of feedlots. So animals that are out there that potentially will go to feedlots but have not gone there yet. We can calculate this from the inventory report. You'll see the January 1, 2023 is the smallest since really following the last drought, 2015, when our supplies were much tighter. Yet the direction is pretty important. The direction is to tighter and tighter supplies. I think that's part of why we're seeing calf prices jump up now is, certainly high fed cattle prices that hit 160 last week, but also tighter supplies when the demand for those cattle is still with us and remains good. And so these tighter supplies, I think, brings home that message again that we got fewer calves out there, and we still have the demand for those calves to go on feed. And so we're seeing higher prices because of that. So I think that's pretty useful. And then the last one of these out of the inventory report I'll point out is the number of heifers held for replacements. We're down almost 6%. That's the second smallest number going back to I just went back as far as this chart goes back to the 90s. That's the second smallest number on record. If we went back 6 months ago to last July, that was the smallest number on record in this data that goes back 50 years. So certainly we've held fewer heifers for replacements. If we dug into Texas, one of the interesting things in the report is if we looked at a ratio of the number of heifers held as a percent of beef cows, that ratio was still in a range that we would say is when we are typically culling more cows and making the beef cow herd smaller. And I think that holds for these national numbers as well. It pretty much indicates that we're certainly not in a rebuilding kind of phase. We're still in a shrinking the cow herd sort of phase. Drought costs being, I think, the main components there. And so certainly that data supports that as well. Let's look at a couple of price charts. We got a heck of a nice rebound in these 500 to 600 pound steers, Southern Plains. I think if we look back, particularly, these and even lighter calves typically exhibit a lot of volatility, but we do tend to see some higher prices into early spring before some declines in the summer. And again, when the biggest supply of these animals come to market in the fall, but certainly strikingly higher prices, really driven by higher fed cattle prices, hitting 160 last week. The demand for the calves, the demand for the cattle are there. So, higher prices because of fed cattle. Maybe a little help on the grain side with some of Mark's vision for grains. That's pretty positive too. But I think the demand for those animals is still with us and it's pulling prices higher. One brief look at cull cow prices. Again, Southern Plains auction, we've seen a pretty nice rebound from in the low 50s to up in the mid to upper 60s. Pretty strong rebound. And you'll notice that red line, we tend to see seasonally higher cow prices really getting clear into early summer, into May, 1st of June. We tend to see those cow prices continuing to increase. For the most part, really we get a lot of, we will start to get grilling season demand for cows. We tend to have fewer cows culled, so a little tighter supplies, a little boost in demand, and we tend to see prices go up. Right now, we're sort of on the same path as we were last year with some higher cull cow prices. I do expect over the course of the year that we'll have higher prices for cull cows this year than last year. Really, driven by some tighter supplies, but maybe some ground beef demand as well. So really, the inventory report and this boost in prices both on the cow side and the calf side, pretty interesting in cattle markets. I think that's my last slide. Let's get out of that. See if I can stop sharing. Andrew, did I stop sharing? All right. Hey, I think Pancho had to leave. He is afflicted with his annual review at 10:30. I don't know if he said that, but he told me to sort of take control when I was done and take any questions and make sure I turn the recording off before we all get out. So we'll see in about 30 minutes if Pancho's still with us.
David, I've got a comment.
Great.
I killed a deer over Christmas and took it to a processor, and they ground it up into 35 pounds of ground venison, which ultimately cost me about $3.50 a pound. It's the first time I've ever had ground venison that was cheaper than the meat I can get at the grocery store.
Yeah, it's we've certainly seen that, whether it's trimmings on the pork side to add some fat to the venison to make the sausage or whatever. The eggs have been the same way. I had a reporter tell me that they were talking to somebody that a small, almost backyard type person, a little bigger than that sells eggs, says it was the first time they could ever that their eggs were cheaper than what they could buy at the store. So
Yeah.
yeah, I think that's a fairly common story, John. Any questions from anybody, for me or any of the rest of the gang?
This is our time.
Fantastic. Well, guys, let me say thanks for tuning in with us. I've heard from a bunch of you saying how that you enjoy doing this, that you get something useful out of it, and we're sure glad to hear that. We're glad to do this every month, and certainly if you have any other questions that come up, let us know, email us, call us, whatever we can do to help. We're certainly glad to do it, and all these slides are available to you. Let us know and we'll get them out to you. And if that's it, y'all have a great week. I'll stop this recording.
See you later.